Hi, I'm Bridget from Money After Graduation, and welcome to a special edition of Drinks and Dollars. I have with me here Joe Snyder from Tangerine Investments. Welcome, Joe.
Thanks, Bridget. Glad to be here chatting with you about personal finance today.
Awesome. Well, I'm so excited to have you because I've actually been a customer of Tangerine, I think, for 7 years now.
Nice. I think I'm going on year 12 or 13, so I got a little bit on you, but that's great. Thanks so much.
I remember setting up my Tangerine banking all online while I was still in my undergraduate degree.
Yeah. You know what? We've tried to really simplify onboarding and always have kind of a much different onboarding or enrollment experience for our different products. Whether it's savings or checking, or whether it's by visiting one of our cafes or kiosks and doing it through an iPad. Even our investment fund account enrollments are completely online, and you can do them in 5 or 10 minutes. It's fantastic.
Yeah, it's awesome. I think I actually check my banking now every day directly on the Tangerine app.
That's such bad behavior, though. Why check your banking every day?
Because I'm watching my spending,
Oh, okay.
making sure that I am staying on budget.
Okay, fine. That's an excuse. I work on the investing side of things, right? And I think people actually tend to check their balances a lot more frequently than they need to. And what I find, and why I chastised you for checking every day, is that can lead to bad behavior. And one of the things that, you know, and I know about investing is we are prone to doing very bad things that are emotional. Like if we see or hear that the stock market went down today, we might click that sell button on our phone when we actually shouldn't even think about it. Don't do it.
Okay, well, you're assuming that people are already invested in the stock market, but
Okay,
I actually
yeah.
find when I speak to most millennials that they're not investing. And I know I was an unusual story because I started investing when I set up my Tangerine account 7 years ago, and
Right.
I started a mutual fund, which I still have, but I'm definitely the exception and not the norm.
So what do you think the norm is then, Bridget?
Well, I think the majority of millennials aren't investing at all. They're intimidated by the stock market. They think there's too many options available, and they just become so paralyzed with indecision they don't choose any.
And there are, right? And actually, this industry has done a really good job, unfortunately, at telling people that investing is super confusing. I find it very frustrating, but this industry is really good at it. The reality is that I think, with thousands of different investing options and different, advisory services or robo-advisory services or direct dealers or brokerages, you're kind of like, I don't know. If you gave me 10 grand, where would I go invest? I would probably go chat with somebody who knew this stuff. I think where companies like Tangerine and a lot of the kind of fintechs that you hear read about in robo-advisory services right now, I think where they are helping clients out and where we're helping clients is by trying to demystify investing a little bit and make it a bit more kind of attainable and not this big scary thing that you need a bunch of money in order to start. So for young people now, I know there are things like debt that we're trying to tackle. At the same time, we all know that we want to retire one day, ideally, right? And so there's always going to be a pull for our resources, right?
Yeah, I think when I started investing, I just allocated $50 every paycheck, so biweekly, into my Tangerine funds. And
That's smart.
I've never changed it. I really just left that and forgot it in the 7 years that I've had that account.
Okay, so that is one thing that you can do, which is great. I'm glad you set up an automatic savings plan on your investment account. That's super smart investing behavior. What you should do, though, probably is check in every year or so and say if you've gotten a raise, then that $50 that you can afford then might be $75 now or $100 now, right? So I'm not giving you financial advice, Bridget, but you might want to consider that check-in.
Well, I have other investments now because I know when I
Okay.
signed up, my mutual fund is actually in an RSP.
Yep.
And since then, I've added TFSAs and unregistered accounts. So what is your recommendation when people don't know which investment account to choose or even what kind of investment fund to choose?
Really good question. I think personal finance can be broken down into rules of thumb a little bit. And I think we start to see all these acronyms that, again, this industry is very good at creating. When what we should be doing is focusing on goals, right? And so I mentioned rule of thumbs. And so there's one rule of thumb that basically says, hey, if you're investing for less than 5 years, you really shouldn't invest in the stock market.
Right.
Because what you're probably doing is trying to accumulate a sum of money that you're going to pull out for a trip to Vegas or that new car that you want to buy or whatever it is. So my recommendation for someone saving for a shorter term goal like that would be open a TFSA, put it in a savings account, create an automatic savings plan onto it, and when you've accumulated the amount you need, pull it out and enjoy what you save for, right?
That's actually what I like about Tangerine, how you can set your savings goal directly in there and tell it how much you're planning to save, and it will tell you when you're going to reach your goal. That's awesome.
If you add a little bit more, you can reach your goal sooner. I think that's really helpful, right? Trying to frame these acronyms and account types and products as goals, and we start thinking about things in terms of goals. So I talked about short-term TFSAs being a great vehicle and probably a savings account as the specific product. But when it comes to these longer, more amorphous, gray goals of retirement out there 20, 30 years away, it's hard to, figure out maybe the best way to optimize what account type or product makes the most sense. And I think that's where people kind of get stuck with a bit of inertia, actually, and say there's too many things to consider.
Right.
So maybe I'll just hold off for a little while and continue saving for that Vegas trip in my TFSA.
Well, I know when I signed up, it actually had me do a questionnaire about my goals and my risk tolerance before I invested any money in the fund. Is that still the process?
That is still the process. And actually, it's been that process since we launched our enrollment for our investment funds in 2008. I think what's really cool is that this type of model is what we hear about a lot with this new word, robo-advice, that didn't kind of exist until a couple of years ago. And it's been our model since the inception of our online enrollment in 2008 with Tangerine Investments.
Wow, that's
awesome.
awesome.
So we're thrilled about the idea that, now that model is going a bit broader and more people, especially younger people, are really embracing it. There's still a lot of work to be done, though. I think the vast majority of folks still use a traditional advisory-based model, and unfortunately, they're paying really high management fees for the funds that they're invested in, and cost is super important.
Well, I find what most young people say when they're looking to make an investment is they can't actually afford it. So many of them have student loans, they have credit card debt, and when they look at adding something else to their budget, even if they know it's important, they can't afford to do it. So what would you say to them?
Do it. That's what I would say to them, is get started with something, right? There's always, it doesn't matter what life stage you're in, there are always going to be conflicting priorities that you have. Debt is a huge one, right? So I'm a big fan of paying down debt, especially if it's really like bad, high interest debt. But having an emergency fund set up is super important. If you don't have an emergency fund set up, again, open a TFSA savings account, put in what you can. $25 a month, if that's what you can afford, is great. More if you can afford more. And because, again, we know we all want to retire, open up that RSP. You're likely going to want to put it into an investment fund that's aligned with the recommendation from the questionnaire you filled out. Set an automatic savings plan on that, and you kind of set it and forget it. Relook at it every few years, or like I said earlier, every 7 years maybe. The important thing is when your circumstances change that you do reevaluate where you're at. Right? So eventually you're going to hit your emergency fund goal of, say, 3 to 6 months worth of salary, and then you probably don't need to fund that anymore.
Right.
You might be able to reallocate those dollars to that amorphously gray retirement thing that's decades out there. That's really how I think a lot of people should be thinking about personal finance. I know it's like not fun and it's not sexy and we don't like thinking about banking. Well, maybe you and I do.
I love thinking about banking.
But I think for most people it's a chore and it's this thing they have to do. And so even in the designs of our app and things like this, we really try to keep that at the forefront, that client experience. And what do people want to do? They want to get stuff done quickly and easily. And so let's make as few clicks as possible.
Awesome. Well, I think that you and Tangerine are doing such a great job with the client experience. And thank you so much for joining me on this special episode of Drinks and Dollars.
It was great to be here, Bridget.
Thank you.
Thanks.